Everyone deserves a good retirement. Even Tony Stark got it. He had a pretty good retirement unless Cap dragged him again into it. No offense to you, Cap, but he was Tony Stark. He had a lot of money. So, what can you do to have an early retirement with a decent amount of money? If you're an investor, then this might be the perfect option for you. I'm talking about ETFs. We're going to talk about 5 ETFs you need to buy to retire early. And at the end, I'll also tell you the benefits of these ETFs, so watch till the end. Exchange-traded funds or ETFs based on indexes may be the best option for you if you prefer to buy and hold strategy of letting properly selected investments amass significant returns over time. Even legendary investor Warren Buffett is aware that index funds are challenging to outperform, which is why he famously insisted that 90% of the money he left his wife be put in an S&P 500 fund. Of course, you don't have to invest all of your money on an index fund as Buffett did. However, as far as long-term investments go, these vehicles are a desirable and frequently affordable option for both big and small investors. There's several options available if you're a long-term investor creating a portfolio and looking to include index funds in it, in terms of assets under management, long-term performance, and expense ratio. So what are the 5 best you can go for? 1. An S&P 500 index fund. With its incredibly low annual cost of 0.03%, the Vanguard S&P 500 ETF is a terrific place to start and might be all you need. But first, realize that an ETF is really a fund that trades like a stock. Therefore, you can purchase as few as 1 share through your stockbroker and sell it at any moment while holding on to your investment for many years. This is a great method to pursue long-term financial security. By purchasing shares of it, you can spread your investment over the majority of the roughly 500 equities that make up the S&P 500 index, which is centered on the largest American corporations. Only 500 of America's thousands of stocks are represented in the index, but when combined, they account for over 80% of the market's value. The S&P 500 is frequently used as a benchmark for the American stock market, or more precisely for large-cap stocks in the country. Do some research on this and other funds you're considering to find out what exactly they own, what fees they charge, etc. You'll see that although this regular S&P 500 index fund contains hundreds of firms, some of them are so large that they dominate it. For instance, Apple, Microsoft, and Amazon are among the top 10 holdings of the index, which accounts for around 29% of its total value. Due to the index's market cap weighting, the largest market cap companies disproportionately impact the index's value. You may suppose that a minor portion of the index's worth is made up of the final 100 or even 200 holdings. 2. A total U.S. stock market fund. The many smaller American businesses, including Kohl's, Mattel, the New York Times, Harley-Davidson, and home builder Toll Brothers, are not excluded by an S&P 500 index fund, which is great. Consider investing in an entire U.S. stock market exchange-traded fund or ETF, such as the Vanguard Total Stock Market ETF. This ETF charges an extremely low annual fee of just 0.03%, which is not surprising given that Vanguard is recognized for its cheap fees. 3. A Total World Stock Market Fund. With a Total World Stock Market ETF like the Vanguard Total World Stock ETF, you can spread your money even further over the world stock markets. Its top holdings are very similar to those of the first 2 ETFs mentioned earlier. But they also include businesses like Taiwan Semiconductor, Tencent Holdings in China, and Toyota Motor. It charges a relatively low yearly fee of just 0.07% like another Vanguard fund. 4. A dividend-focused fund. You could particularly value an index fund that offers a dividend if you're retired. The ones mentioned above pay out, but a dividend-focused ETF, such as the Vanguard Dividend Appreciation ETF, will pay out more. The Vanguard Dividend Appreciation Fund recently has a dividend yield of 1.74% compared to the Vanguard S&P 500 ETF's 1.34%. Its annual charge was also only 0.06%. With the exception of the S&P Dividend Growers Index's negligible expenses, this ETF seeks to mimic its performance. This index focuses on businesses that have continuously paid dividends, often for at least 10 years. It's interesting to note that the top 25% of the companies with the highest dividend yields are not included, as an extremely high yield is sometimes associated with a struggling company. Real estate investment trusts are likewise excluded from it. Microsoft, United Health Group, Johnson & Johnson, Visa, Coca-Cola, and Costco are a few of its key holdings. 5. A real estate fund. Speaking of real estate, REITs make it simple to participate in the stock market sector. Retirees benefit since REITs are mandated to distribute at least 90% of their earnings in the form of dividends. The Vanguard Real Estate Index Fund ETF, which has an annual fee of 0.12%, is one of many REIT-focused funds to take into account. American Tower, Public Storage, Realty Income, and Digital Realty Trust are a few of its main holdings. Vanguard notes that it cannot provide a specific distribution amount because the yields of such companies tend to vary with their fortunes, in contrast to regular common stock dividends, which typically are held steady until enhanced, or in difficult times, cut or eliminated. However, Vanguard reports current effective yields between 1.8 and 2.6% on the ETF's website, depending on whether the number has been modified. Now we've talked a lot about investing in ETFs, but why should you? What are its benefits of it? Don't worry, I got you. 1. Diversification. When you purchase an ETF, you make a single transaction involving hundreds or even thousands of distinct assets. It immediately spreads your risk. An investor can quickly and simply create a portfolio that includes a variety of asset types and regions by using ETFs. 2. Accessibility. ETFs often have relatively modest minimum investments, so you don't need much cash to start. With just a few hundred, you can begin assembling an ETF portfolio and add more as you go. 3. Cost-effectiveness. ETFs are economical on a variety of levels. You would have to pay your broker a commission each time if you had to go out and purchase each of the 500 stocks that made up the S&P 500. These costs can really mount up and hurt your refund. Because you just have to pay one brokerage charge when purchasing all 500 shares at once with an ETF, creating a diversified portfolio is substantially less expensive. The fees levied by the provider of the ETF make up the second degree of cost-effectiveness. These fees mostly pay for their overhead. ETF fees initially began off at attractive levels, but many ETF providers have now slashed their costs for investors. Some now charge nothing at all. 4. Liquidity. ETFs are traded on exchanges. You can buy and sell them at any time. In other words, investors can swiftly and fairly sell an ETF to realize their gains. In comparison, investing in something like a house can be viewed as being less liquid because it would take longer to find a buyer, and you might have to accept a substantial discount if you ever needed to sell it quickly. 5. Transparency. ETFs make daily holdings disclosures, so you always know what you're buying. Unlike traditional funds, which typically only disclose their top 10 holdings, and even then, frequently on a delayed basis, ETFs typically allow you to peek inside and see exactly what you're buying. This was all for today. These were 5 ETFs you should invest into. Do let us know your thoughts in the comments, and I'll see you in the next one.